Hey everyone, it's Imran back with another macro option spotlight for you. All right, equities continuing to explode a bit higher into expiry. We thought we were going to be more pinned down at 41.50. Wasn't the case. Market's got a whiff of this debt ceiling deal potentially getting done, and the bears are getting twitchy, and we're seeing the Nasdaq rip higher. So Nasdaq leading the way up another 1.8%. You can see here that's a 1.7 sigma move. So really leading the way. That's now up 3.3 on the week. That's a 1.4 sigma move on the week. Commodities continue to break lower. You can see quite a bit of red here, particularly in precious metals. Copper's been chopping around. It was down 1.5% yesterday, but on the week, it's fairly unched right now. But the big standout is Nat Gas, which is up 17%. We have been banging the drum about this, saying that Nat Gas looks like it's turning. The skews move first. When that skew diverges from spot, it's trying to tell you something. And we've been trying to tell you that same thing. It was up 8% yesterday. We've got UNG back to 7.5. So those of you who bought those June calls, as we've been talking about, would have done all right. Okay, yields continuing to climb on anticipation of more issuance, as the TGA is going to have to be built back up because they've drained it down to nearly zero. So once the debt ceiling does get done, we would expect something like that to happen. And people are wondering whether that TGA going up, Treasury issuing more bonds when they're allowed to, is that going to suck money out of the system and create a bit of a dollar bid and also a bit of a risk off move in markets? That's the question. Remains to be seen, but it is a risk for markets. Looking at implied vol and carry, really seeing quite a bit of red here again. Equity vol generally softening as markets rally, as it tends to do. The only exception there is this big 2.5 pop in Nikkei vol, which is now up 4.5 vols on the week, on a week where Nikkei is up 5%, which is a 2 sigma move. So Nikkei absolutely exploding to the upside. Remember, we mentioned Warren Buffett was buying it a few weeks ago, whenever he was endorsing it, basically saying he's increased his position in some of these Japanese names. Well, the rest of the market's finally cottoning onto that and taking Japan higher. Looking over at the rest of the vols, metals vol drifting lower with spot lower, and Nat Gas vol finally responding and popping a couple of points as it moves up. But I would have expected it to pop a bit more than that, given that it's rallied 17%. But if this move continues to gather momentum, I would expect Nat Gas vol has got some more upside in it potentially. Carry wise, we're seeing a lot of green back now across equities. Only really China in the red, and then copper is your best gamma, long gamma play in commodities, where it's moving vol adjusted better than everything else, and gold is actually the worst mover right now versus its vol. FX carry generally turning a bit more positive again as well. The commodity currencies are still in the red, but those numbers are shrinking. I mean, CAD was at 50% plus the other day. It's coming down pretty quick. And then bonds and sectors all remain in green. So, generally rewarding the short gamma players, particularly XLV, which is the healthcare sector, which is realizing 5, which is next to nothing, basically. And then wrapping up with skew, we are seeing equity skew falling again on the market strength as fears abate and hopes of an imminent deal rise. See a lot of red on the skew board there. Reasonable sort of pullback in skew. We were up as high as like 60, 70 percentile. We've got that back down to 30 on the S&P. So you can see that's there. Commodity skew firming up a bit on the general weakness in spot prices. Even natural gas skew firming, which is weird, given that it's rallying so hard. You'd expect it to go more into cool territory, but that's not what we're seeing right now. FX skew has been trickling a bit higher. You can see here 20 basis points higher in the likes of euro and sterling. And that's for dollar strength, basically. People cottoning on that the dollar might actually start to build off this bounce. And so you're starting to see skew reflect that a little bit in FX land. And then lastly, the only thing to flag is HYG skew coming off a reasonable amount there, back towards the lows, actually. And that's on the back of some June put selling that's been seen in the market, basically having a bit of market impact. All right, so that is the general summary of what's been going on in spot vol skew. Okay, looking on recent data in the US has been better. So you had Philly Fed and lower jobless claims showing that the US economy is more resilient than people think. This has helped the dollar find some relative strength, and it's taken yields higher off their lows that we saw earlier in the last few months. Markets are now pricing in a 40% probability of another hike in June. And that has popped from about 10-15% only a week ago. So this stronger data is definitely kind of repricing the idea that there's maybe still a bit more work to do from the Fed. Okay. Now the hard data is coming in stronger, but the leading data is not so good. So Deutsche Bank have got this recession probability model, and they basically got it to 100. They think their model is predicting 100% chance of recession in the next 12 months. Okay. Now take what you want out of that, but judging from the price action in markets, stocks really don't care. Okay. The tech outperformance in the last few weeks, even as rates markets have turned back higher, that's a divergence, right? Generally, Nasdaq cares what rates do, and it really doesn't right now. And this decoupling of the Nasdaq can only really be explained by the excitement around AI, which seems to be reaching fever pitch. Okay, so we think it's a hard one to fade, but it's probably the most crowded trade in town right now, the AI trade, and all these mega cap techs just catching an insane bid. And you know how crowded trades play out, right? Anyone who's seen gold in the last few days knows when trades get crowded, they are vulnerable to a correction, and gold is showing us exactly that. So don't be surprised if at some point all these AI tech stocks take a bit of a shoeing. Hard to call it, I know, but just be aware of that. Okay, you can chase these things, but you have to learn how to chase them safely. Okay, all right. What else? So today I'm going to give you guys a lesson in volatility arbitrage. Okay. So when you trade options a lot and you understand how the volatility surface works, which is my goal to kind of show you that, you begin to spot interesting relative value opportunities. Certain parts of the surface look cheap versus others that look expensive. And they're essentially both giving you the same exposure. So you can buy one and sell another. And that gives you some efficiency in the way you implement a trade. Now, the charts on Nasdaq obviously have gone through the roof on the upside, looking very overbought. But looking at the vol charts, we can see that vol has been getting slammed. So this strong downtrend in volatility, particularly the front end. You can see the term structure. That front end has really collapsed recently, the June stuff. The back end has fallen as well, but not as much. But we have got a steepness in the curve, which is a regular contango shape, which is quite normal. And then you've seen skew here has been going higher since the start of the year. It has definitely pulled back off the recent high, but it is still more elevated than it was last year. So these are the things that we're seeing in the implied vol surface on Nasdaq. Okay. Now, using my experience, I look for ways to express my views efficiently and maximize my risk reward. Okay. So we like the idea of owning short dated puts and selling medium dated puts, short dated close to the money stuff, and selling downside medium dated stuff to basically fund that. Okay. And the idea there is you can net receive premium so that you'll make money from a pullback in Nasdaq, which is what I'm looking for. But if Nasdaq explodes higher, you could also make a little bit of money because you've net received premium. Okay, so that's the idea. Now, when we're doing volatility arbitrage and we're buying this and selling this and doing ratios and all that stuff, the really important thing we need to do is scenario analysis. Okay, so in constructing options trades, this is a very important part of the process because you need to understand what your risks look like for different size market moves and how it works through the passage of time. Okay, so you can see if all we did on Nasdaq was we bought, say, the at the monies, the 335 puts on Qs for the end of June, because that will kind of capture the debt ceiling, hopefully. And then you sell double the notional, 2 times the September 305s, which are downside, like 20 delta puts. If you sell 2 of those, then you look at the scenario analysis and it looks pretty good, right? You kind of don't really lose any money around here. If we explode to the upside, you make money. If we go down, you make money. Through the passage of time, you make money down to around 300, which is where that short strike is. What's the problem? The problem is down here, right? This big lump of red that if the market was to crash 20%, you're going to be in a world of pain, okay? So generally, that's not going to help you sleep at night. Okay, so what can you do about that scenario? You look at the relative value. You like that part of the curve versus that part of the curve, but the relative value of that, doing that spread, is going to blow you up in a down 20%. It probably means the margin requirement that you have is far too high for a retail trader to be able to do that and actually have enough capital to put that trade on. So what do? Well, you just buy some downside puts in the end of June. So if you buy the 295s, which are way out of the money puts at the end of June, then that flips your scenario. So rather than having all this red on the way down, you actually gain on the way down. Okay, so you can see now we've got a load of green down here because all we've done is we've spent 90 cents, which isn't a whole lot, on this structure. We're still net receiving, about $3.6, whereas here we were receiving $4.5. but you're basically taking in a bit less money, but you can sleep at night and your scenario looks much better. And you can see here, you've got a very small bleed if the market stays in the range. But again, on the explosive upside, you'll be in the money. And on the way down, you're going to make good money. And you don't have to worry about this red bit where you get into trouble if the sell-off happens too quickly. So that's what scenario analysis is about. And you've got to make sure you do it if you're trading multiple leg trades in options and different expiries and stuff like that. Okay. So where we landed? So we've landed on the triple Q. If this was way over your head, don't worry. We run boot camps every quarter. Come to one of our boot camps. You can learn all about this stuff. You can ask me as many questions as you want, and you can learn to really understand and trade options like a guy who's been doing it for over 20 years. All right. Thanks a lot for listening. I'll catch you guys next week.